And hell's coming with me, you hear? Hell's coming with me!
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. I hope you have enjoyed the first half of July 2022. We just wrapped up a coffee and real estate on Saturday morning, just this last Saturday. Lots of interesting information there relating to our local markets. I hope you can take a minute to check that out over on Facebook Live. You can look at it at Facebook Live. You can check it out on Twitter. You can check it out on Instagram. You can check it out on Twitch. And where's the other place you can check it out? LinkedIn. Did I say LinkedIn? So it should be up on all of those. Find me on any of those. You can search on Rebel Broker or Robert Whitelaw. Either one of those things will work to help you find it. If you'd like to participate in the next one, we do one every third Saturday of the month, and we review the data for the previous month for Santa Clara County, San Jose, and Morgan Hill, kind of going from totally big view of the county, next the largest metro area in the county, and next Morgan Hill as a smaller sort of not micro, but smaller market in comparison to the others that we talk about, to give us some, some perspective on where we're at. So please take a minute to check that out. I think we covered some interesting stuff. One other thing I wanted to mention, I know this is a little bit self-serving, but there was a article that came out from a website called Berkshire, BERXI.com. They released the top 10 best real estate podcasts for brokers in 2022, and this show, Real Estate Realities with Me, was number 3 on their list. I'm not going to claim that they ordered them in order of preference. I'm not going to assume I'm actually number 3 in the world of real estate on podcasts, but I'm in the mix, and it was an honor to be included on a list with some other amazing shows that I personally enjoy, like Better Pockets, for instance, is a great one. So feel free to check that out. You can see past shows if you're new to the podcast. If you're someone who found me through Berkshire, I did notice I got a few folks who came over from Berkshire to check out the podcast. So welcome to the podcast. And if you'd like to check out more, go to therebelbroker.com. And there's a player right there, and also links to a variety of different ways for you to consume the show, whether it's on Apple Podcasts, iHeartRadio, Google Podcasts, Spotify, Amazon Music, or just a straight up RSS feed, however you want to do it. I'm also up on Audible, so you can find me there as well. All free, so feel free to jump in and enjoy. And I'm always interested in getting questions from listeners. If there's topics that you'd like me to cover, or you have specific questions, I would love for you to either bring those to one of our Saturday coffee and real estate live chats, so that we can deal with it right there live, and other listeners can benefit. Or feel free to head on over to the Rebel Broker or to soldbyrobert.com. Reach out to me there where it says contact. Just click that and you'll be able to contact me. And you can submit your questions or ideas or suggestions that way as well. I love hearing from listeners. It's always a great experience, particularly folks who are in other markets that I'm not totally up to date on. And I love to hear what trends and things you're seeing there. Now, today's topic, not a happy topic, unfortunately. I don't think we're going to see a whole lot of happy topics coming up. Actually, this morning on the YouTube version of the live chat, the Coffee and Real Estate live chat, I got a question from someone actually this morning that I just took a look at, where they were talking about or asking about, what's going to happen with inflation and interest rates and all that kind of wonderful stuff. And what does that mean for our local San Jose market? And I think it means the same for the San Jose market as it means for all the other markets. Just to sort of calibrate you to the yin and yang of this, when you have inflation like we do, which is insane. Our inflation rate now is nuts. It's over 9%. And we're going to talk about that. Today's topic is, what's going to happen with mortgage rates. When you get interest rates that high, when you get inflation that high, interest rates are used to combat it. And interest rates have to be raised in order to combat inflation. At least it's one of the main tools that they use. Another method is to buy back debt, which is also happening. But remember, printing up money is debt. And we have done that to the tune of trillions of dollars over the last couple of years. For those of you who have been longtime listeners to the podcast, you know that I was annoyed when then President Bush passed the bills that allowed us to print up hundreds of billions of dollars during the downturn. I didn't think it was a good call then. I don't think it's a good call now. But somehow this is the magic get out of jail free card that everyone seems to pull out. And I love the dynamic. I mentioned this on Saturday morning. Whenever they screw things up, it's all about headwinds and external things that just came along and screwed things up. It's never their policies that screwed things up. But then when things finally turn around, or when things are bad, it's like, man, imagine how much worse it would have been if we hadn't been involved to help deal with this issue. And then when things get better, it's all, well, thanks to us, things are better. We're the solutions people. And remember, these are all the same people. The same people that drove the bus off the road are the ones who are telling us, no problem, my skills are to the task of getting this bus back on track. Which for me just seems like a better argument for taking control of these things out of the hands of these folks. And that's a totally different argument. That's probably something we talk about over an adult beverage somewhere here in Morgan Hill to decide how happy we are about the Fed or any of these other kinds of weird financial things. But the reality today, the on-the-ground reality for all of us, is that we have an awful lot of folks who are in charge of this. We have a managed economy, and we can make other arguments about how that can end up resulting in some unfortunate collusion and corruption that feeds certain needs over other needs. But the reality is you have to raise interest rates, and along with buying back debt, to fight inflation. Well, how much do you need to raise them? Well, given how much we've printed up, given the inflationary things, the inflationary policies that have been embraced, 6% interest rates, not going to do it. It has to, and this is something I've been saying for a while, it has to go up a lot. Now, remember, in my mind, 10%, 11%, 12%, 13% interest rates aren't a shock. When I got into real estate I got my license as a real estate agent in 1988. So for those of you who don't remember, there was a savings and loan scandal, right? And all of these wonderful things happened that screwed up the markets, and interest rates were crazy. We were at, I think the day I started, don't quote me on this, but it was in the teens. I seem to remember it being 13 point something percent. And I was keeping an eye on different, I can remember the week when interest rates dropped below 10%, and suddenly everything was selling because no one could believe that interest rates would get below 10%. Oh, we'll never see interest rates at 9 point something percent again. We need to buy now. So that's how differently calibrated people were back then. So fast forward to today, where we've had a decade of folks being used to interest rates at 2.5%, 3.5%, which is historically unbelievably rare. It is the unicorn of interest rates. So whenever I talk to people directly, are we ever going to see 2.5% interest rates again? Well, maybe, right? Given a long enough timeline, anything can become true. In our lifetimes, not so sure, or at least in my lifetime. A lot of you have a lifetime that's going to go way beyond where I am, but I don't think that's necessarily something that we should count on. I don't think you should say, I'm not buying another thing till it's back down to 3.5%. I want that 3.5%. Don't suggest you do that. I think it's going to be a severe hamper to your strategy. But now we're faced with this challenge of right now, today, we have the reality of inflation, right? So that's what we're fighting. We are fighting the enemy that's already inside the castle walls, which is inflation. Recession And I know a lot of people want to quibble over whether we're in recession or not. I guess we're not officially in recession. But as I've said to other folks, when you have fallen off a cliff, it is a little bit academic to argue about whether or not you're going to hit the ground. For where we are, the things that are happening, I do not see recession as an avoidable thing. And I'm not going to say that this is the truth. I'd actually love for this to be a conversation I have with you all. Is recession the chemotherapy we need? Is it the economic chemotherapy that we need? In other words, it's going to hurt. We're going to feel horrible. Terrible things are going to happen. But does it have to happen in order for us to come out of this in a healthy economic situation? I can't say one way or the other. I need to do more research before I can make that argument. But I don't think that that is a ridiculous suggestion to throw out there and have a reasonable conversation about. Now, having said that, the recession is going to come. It is going to arrive. So at what point does it enter the city walls? At what point is it now more relevant, more important, more impactful to deal with than inflation? Because here's the thing. Interest rates, just like most tools, they work for some things when you raise them, and they work for other things when you lower them. So for inflation, raising interest rates is the common wisdom. That's what you do. You raise interest rates when inflation is high to reduce inflation, in addition to the other things we talked about, buying back debt. However, for recessions, you lower interest rates because you need more mobility of money. Because the things that define a recession tend to be unemployment, reductions in income, lowered retail sales, lowered manufacturing, right? So by greasing the skids of financial mobility, right, or accessibility to funds, you encourage companies to grow because money is cheaper, right? So borrow money to do X, Y, and Z, whether it's research and development or grow your company or whatever. But recessions can take a while to resolve, right? I think I recall reading that the typical recession, you hit its peak after 18 months, and then it starts to get better after that, right? So we are potentially looking at a 3-year window of time where we will be under the influence of some level of recession, or in the middle of that 3 years, we are at the worst point of that recession, right? So at what point do we shift gears on interest rates and reduce them enough to fight recession, but not enough to reinflate inflation? Right? The same thing that solves one problem makes another problem worse. So there's going to be a magical point where the folks who claim to know the most about this stuff and are in charge of it will have to switch from raising interest rates to lowering interest rates. So what does that equal? Well, as I've said before, interest rates are not directly linked to mortgage rates, right? That's the 10-year treasury. However, in terms of the most proximal way to guess where interest rates are going to go, right? If you see 10-year treasuries going one way or the other, you can guess that pretty real soon interest rates for mortgages are going to go up or down based on the change in 10-year treasuries. But remember, treasury notes are debt instruments, right? You issue the notes to print the money. So what we're in a situation is these things eventually trickle down to interest rates for mortgage lending. They will, but they are less of an indicator than the 10-year treasury. In other words, if you want to know what interest rates are going to be next week, you look at what 10-year treasuries are now. If you want to know what interest rates are likely to be further out than that, then the general interest, the prime rate is a good one to look at. And I'm using arbitrary timelines here. The what it'll be next week argument, don't write that down as gospel. It just means that a change you see in a treasury note is going to indicate a change in mortgage rates sooner than a change in prime rates, right? Whatever that timeline is, a lot of it is also psychological, right? Because we've often seen changes in the prime rate that then see things jump for literally a couple of weeks and they go right back down to a lower rate for mortgage rates. So there's definitely a psychological element to it, but I'm complicating things. The question we need to answer today is, what's going to happen with mortgage rates in the near term? And there's a very interesting article from Realtor Magazine where Lawrence Yun, who is the main financial guy for the National Association, he's the chief economist for the National Association of Realtors, a gentleman I have frequently disagreed with. And man, I want to know how long he's been in this job, because I haven't had to learn a new name of a chief economist for the National Association of Realtors, I think, for 10 years. So he's been at this a very long time. And whenever I get things from the National Association of Realtors, I'll often try to put on a more skeptical hat, because frequently what you'll hear are things that encourage more activity in the real estate market, because they want to try to paint things or position things in the best way possible for what's happening with real estate. Why? Because the National Association of Realtors makes their money by having lots of real estate agents paying lots of dues. So I'm very much a follow the money guy. In any scenario, you find out who's making the most money off of a thing, and then you make sure to interpret what's happening based on that, because it's always going to be playing a part, right? Now, just the lead in on this article, and this came out July 13th, so just a few days ago. Inflation rose to a new 40-year high in June and is accelerating even faster than expected, according to data from the Bureau of Labor Statistics Consumer Price Index. Consumer prices jumped 9.1% last month and posted an annualized inflation rate of 17%, much higher than economists predicted. So let's focus on that for a second. When something is much higher than economists predicted, the people they're referring to are the folks that are either advising or are the people who decide what's going to happen with interest rates. And they're faced with this challenge. While everyone in the headlines may say, hey, hold back, we're not officially in a recession, they see that bear running toward the castle wall. So they need to try to deal with the situation they have before that thing gets here. But again, it's a balancing act, because these interest rates, as we raise them, may fight inflation. But the more we raise them, the more energy that bear gets to arrive quicker, right? The recession bear. Maybe the bear was the wrong choice. That's what I went with. I'm gonna own it. So I, frankly, do not have, and remember, for those of you who've been listening to my podcast for a while and the other things with which I throw ideas out into the universe, I've been calling this one for months, that there is no way that the current rate of increasing interest rates is going to make any kind of a substantial dent in inflation. Because here we are at 9.1%. When I first started talking about this, inflation was at 5%. And I said, there's no way. Inflation's going to keep going. It's going to keep rocketing up because we are not raising interest rates enough to deal with it. Because no one wants to make the painful decision to do one thing or the other. So, given this reality, given the optimists in the room being slapped in the head with the latest numbers, because there's no other way to describe these small interest rate and it is a small interest rate increase. This 3 to 6%. What was it? I checked interest rates yesterday and it was at 5.25. I mean, down. I'm sorry, that's not going to do it. I think the last stake in the ground that I put relating to interest rates was we got to be over 10% before we really start fighting inflation. So I think that we're going to see a jump in interest rates to fight inflation. And I think I agree with Lawrence Yun, which is a shocker. Here's a quote from Lawrence, from Mr. Yun. Let's now that we're in a scenario where I actually agree with him, let's give him his due. Quote, "The Fed may be forced to raise interest rates even more aggressively than planned, even with the rising possibility of a recession on the horizon," says Lawrence Yun, chief economist for the National Association of Realtors. Continuing on, he says, "The mortgage market had already factored in several additional rounds of the Fed's rate hike, but may have to adjust a bit higher based on today's uncomfortable inflation rate." So that's a very mild way of saying it's not working. The things we have done have not worked. So we do more of it to try to make it work. Now, the article goes on to say that could be a major blow for aspiring buyers who have been nervously watching mortgage rates climb drastically over the last few weeks. The 30-year fixed-rate mortgage averaged 5.3% last week, up from 2.9% just a year earlier. That's right. Interest rates were at 2.9% 1 year earlier. I mean, wrap your head around that. That's just 1 year, according to Freddie Mac, according to their numbers. Meanwhile, home prices have risen 15% over the past year. Note, home prices are not included in the latest inflation figures. What a surprise. In fact, that's an interesting thing. If you ever want to just understand the weird shell game that is calculating these numbers, take a look at how they calculated inflation in the 70s and 80s versus how they calculate it today, because they don't calculate it the same. And I love how you can change how you calculate a value, but still plot all these values on the same graph, even though earlier versions of that number were plotted in a different way. I just love that. That seems so fundamentally self-deluding. If you change the way you calculate your indebtedness, right, and you appear less indebted now than you did 10 years ago simply because you changed the math, but you still keep the same graph data, it blows me away. Anyway, I digress. Home prices are up 15% over the past year. Likewise, the 50% rise in monthly mortgage payments this year versus last year also is not reflected in these numbers. Interesting side note, Saturday when we were doing coffee and real estate, I just happened to went ahead and went to the Smart Asset Mortgage Finding page, right? It's a page I frequently look at to see what interest rates are like for both originated 30-year mortgages and for refis. And the current rate was 5 point something, 5.3, 5.2, something like that. And I put in the average price of a Morgan Hill home, which is just a little over 1.5 million, and I just put in 1.5. So you had to come up with $300,000 for a down payment, and your monthly cost just for your mortgage was like $6,400, something in that neighborhood, which is ridiculous. Let's see. A new Forbes analysis shows that mortgage rates have contributed to higher monthly mortgage payments more than rising homes. The publication's analysis shows that in the past 12 months, the typical monthly payment has increased up to 57%. Higher mortgage rates alone accounted for $408 of the average $725 increase in payments. So keep in mind, at the same time, you are paying more for everything: milk, cheese, Milky Way bars, Pepsi, water, gasoline. Mortgage rates are up 57%. While home prices accounted for $239, the analysis notes, the remaining balance came from higher mortgage rates that were applied to a higher principal. Quote, the homeowners who locked in low rates the prior 2 years have fixed non-rising monthly mortgage payments, Yun says. That's, quote, a different story for renters. Renters rose by 6% from last year and are rising at a 10% annualized rate. Rates will continue to rise in the upcoming years. So here we are. I would not be surprised if before the end of this year, we are talking about interest rates nestling up to 10%. I think that mentally 10% is the there be monsters here that you see on the old maps, right? I think mentally there is a, oh my God moment that happens among the entire population when you hit 10%. I would not be surprised at all if before the end of this year, we absolutely see interest rates in the range from 7 to 9%. But to be honest, I don't think we solve inflation till we're at or over 10% interest rates. Now, that's just me. I'm just some real estate broker guy who reads a lot of really boring stuff about these things. But that's my take on it. I don't have a finance degree. I don't work for the Fed. I don't work for a bank. But there's something to be said for 30 years of practical experience on the ground watching these things go up and down. that I think is a reasonable thing. I think and again, I'm not even talking crazy talk. Crazy talk would be saying 18%, 17%, right? A place we have been before. And if you look at the scale of what we're dealing with and compare it to past instances, the argument about whether or not we should go to much higher than 10% becomes far more reasonable. Now, what does that do to the market? Well, I think it does an awful lot of things. We've already seen a 52% reduction in the origination of mortgages with where we are. Half of the people who were out there buying said, all right, I'm out. I'm done. I'm not going to buy. I'm going to continue to rent. And in Santa Clara County, that may make a lot of sense when buying a 3-bedroom, 2-bath home would have you with a mortgage of $6,000 plus when you could rent a 3-bedroom, 2-bath home for $2,000 a month less. Right? Or $3,000 less, depending on where you're looking. So does that spell an opportunity? Well, it does. I mean, but it's half of one or six of another, half dozen of some or six of another, where the cost goes. It's the difference between, okay, now I'm paying less for the home, but I'm paying more to rent the money I'm using to buy it, right? And not just a little bit more, but a lot more. And here's the problem. So point number one of today's show, we are hosed on interest rates. Much higher interest rates are coming. They're coming faster than you think they're coming. And we're hosed for some period of time. Don't know how long. It really depends on how long. It depends on when recession arrives and how far we get into recession before we feel like we've got inflation taken care of enough. But I'm not convinced that will happen. I'm not convinced that doing all of this will actually reduce inflation enough. I really want to see it. I am a cheerleader for it happening, but I'm not seeing it. I am not, because look, I mean, yeah. I mean, we all know the history of this stuff, right? Bad things happen. It's never the government's fault. It's never the Fed's fault. It's never policy's fault. It's all this other stuff. And then taking credit for fortunate turns that really never should have been needed, because if they'd done smarter things earlier. And unfortunately, the smart things aren't necessarily the painless things. Sometimes the most painful thing you have to do is the only thing that will get you out of the hole. I kind of feel like we're getting there really fast. So, are interest rates about to go nuts for mortgages? Yes, I believe they are. I'm just going to say yes. Crystal ball is out. Tinfoil hat is on and stapled to my scalp. Yes, interest rates are going to go nuts. But what does that mean for our real estate market? Where does that take us? Well, I think that it's one of those things where it's still math for investors, right? It's really just doing math. But the problem is when it's an investor scenario and you're just doing math, what you end up doing is still seeing crazy increases in rental costs, because in order to make the math work, rent has to go up. At least for those who attempt to acquire investment properties in this kind of an economic climate like this, that's the requirement. So, because it is math, the price of properties for you to invest in. Now, of course, there's a difference between a single-family residential home and multifamilies, right? If you're an investor, single-family homes have a much higher emotional involvement, because the people you're competing against could just be folks who want to live in that house. So they're willing to pay more for reasons you aren't willing to pay more. They really love it for whatever reason. For you, it's not about loving it. It's about seeing it as a good investment, and the math works. So what happens in the multifamily space where that emotion tends to be taken away? Well, those sellers who are trying to sell multifamily units are going to take it as a hit, because as an investor, it's all about the math. And if you can't make the mortgage side of it work, if you can't make the borrowing side of it work, you got to make the purchase price part of it work, or that thing isn't going to sell. For those of you that are looking to buy a home, the theory is going to be you buy and then you take advantage of lowered rates when it happens. Because here's the other thing. Once we get solidly into a recession, they will lower interest rates eventually. They have to. It's in the checklist of stuff to do when you hit a recession. Like number 1 or number 2 is reduce interest rates. It just is. So while you may be stuck with buying initially at a rate that makes you want to cry, you can do that with the idea that I'm going to refinance down the road. Now, is it a gamble? Absolutely. Depending on what reactions we get from the folks in charge, this could go a lot longer than 3 years. Hopefully not. Hopefully that's not the case. If you're betting the odds, because if you're betting the odds, you buy it as a buyer the best way you can. Make sure the finances work for you. Because again, for you as a buyer, it should still be about math, right? You make a certain amount of money per month. Do not allow your housing cost to exceed whatever it should not exceed, right? You can determine that. Now, a bank, what's the percentage the banks like to use? This is a number I've had in my head for years, and I can't seem to get it out, call it up. I want to say like 30, 40%, something in that neighborhood. 50. I know there's some folks who have done up to 50%. I guess it depends on your overall credit rating. But imagine what kind of a debt portfolio we find. Now, for those of you who've been longtime listeners of the podcast, you know, debt portfolio, debt profile was a commonly used term by me when we were talking about things that feed the beast that cause bad things. Because as we chatted about on Coffee and Real Estate on Saturday, there's a whole lot of other things going on. We're already seeing an increase in foreclosures. Obviously, a lot of the moratoriums on foreclosures are gone or going away. Repos of cars are double what they were the same time last year. All of this feeds an overall debt profile. That means people will start making tough decisions, right? We have some very goofy monetary decisions, particularly here in California, where they will let someone buy a home with zero money down. You have to be making 80% or lower of the average income. So it is basically aimed at the people least equipped to take on debt in a trying time when things are about to get bad. So there's one more thing that we could talk about that feeds the beast of dumb things to set the stage for really bad stuff down the road. Now, I'm all for people being able to buy their own home. I think it's an awesome thing to be able to own your own home. I think it's a good feeling, right? Not only from the this is mine standpoint, but I can poke a hole in this wall. I can do anything I want to this home. It's mine. I own it. And I now will be benefiting from whatever equity grows out of this home. However, having gone through the last downturn, I do not agree with the theory behind that supported subprime lending, that folks who can't afford should be allowed to afford through increased debt. Debt is a yoke. Debt is a weight. Debt is an anchor around your neck. And to think that these folks won't make rational decisions when they have zero skin in the game, no money at all, they have financed 100% of this house, and suddenly things make a turn for the worse. A recession occurs. Incomes drop. Manufacturing jobs go away. Retail jobs go away. Now, where do these folks in the lower income groups tend to live in the work world? Is it retail jobs? Because if it is, those folks are suddenly going to see a hit to their income. And when they realize, I really won't lose anything if I just bail on this house, right? Because I've got no money in it. I've been financed 100%. Well, there you go. That feeds the beast that got us screwed over last time. I'm letting that sink in. I'm taking a moment of silence for financial sanity. For my money, whatever you were going to invest in giving subprime borrowers money that they're not financially mature enough to manage that debt, take all that money you were going to use that for and offer free education on how to manage your finances. What is smart financial decision making? Because we sure aren't teaching it in high schools, at least not in California. Maybe that's happening somewhere else. But anyway, That's a little bit off topic. What's the punchline? We're hosed. Interest rates are going to go nuts for mortgages. A year from now, we may be lamenting the days when we may be pining for the days when we didn't have double-digit interest rates on our loans. We may be over 10% in a year. I think we'll be really close to 10% before the end of this year. I think we will be closer to 10% than we are to 5% within the next 6 months. By Christmas. We'll see how well that prediction ages, but that if you're looking to acquire a home, okay, given all of these realities and the realities of the market data we covered on Saturday, I think that while this is all true, there are some amazing opportunities that will be presenting themselves on the purchase price side. Not a huge comfort, I realize. But the purchase price thing isn't a moving target, right? Once you've paid the purchase price, you've paid the purchase price. On the financing side, there's a variety of different things you can do. Now, I do not suggest you get an adjustable rate mortgage because I think for the foreseeable future, interest rates are simply going to go up. And I think when they readjust and your amount jumps, depending on how long the freeze period is, right, on your adjustable rate mortgage, I honestly don't think, unless you've got like a 5-year arm where it's adjustable, where it stays fixed for like 5 years, I think maybe that's a reasonable option. But we'll have to see, depending on how long this goes. But I think interest rates will be higher. If you're buying today, I think that you need to be thinking, how long does this stay frozen at this percentage? And make your decisions appropriately. So that key to your adjustable rate mortgage is going to be the adjustment period. How frequently can those rates adjust, right? A 1-year ARM, for instance, the mortgage product would be called a 1-year adjustable rate mortgage. And then it could change once every year. If the adjustment period is every 3 years, it's a 3-year adjustable rate mortgage, right? There are also some hybrids, 5-1 adjustable rate mortgage, which gives you a fixed rate for the first 5 years, which the interest rate adjusts once every year, right? So understand what that stuff means. Don't, because you're going to get yourself hosed. And remember, this is exactly what fed really bad stuff the last time. When folks get to that period where it starts to adjust, and with all the people buying right now, right, all the people who've been buying for the last 6 months using adjustable rate mortgages, remember, a lot of them are going to see their rates adjust a year from then. So this time next year, we are going to see people whose adjustable rate mortgages have gone up to the point where a lot of them aren't going to be able to continue to afford that mortgage. If you got a 1-year ARM this year, wow, that was a really bad call. A really bad call. I hope you didn't. I managed to talk an awful lot of folks out of adjustable rate mortgages. So anyway, all right. So I think that's about it. We've gone actually a little longer than I'd planned for today's show. This one gets me fired up because there is so much dumb in it, right? There is so much problems we're facing caused by decisions made by folks who are supposed to know better. There is so much unwillingness to do the bad thing that's going to make them look bad. Of course, they'll never own it. It'll always be some other thing that was the problem, and then they'll be responsible for the solution. But all of us have a tough time coming. We have inflation that we're trying to deal with. If you did not get a raise of 9.1% this year, you got a pay cut. In fact, to break even, you needed to get a 9.1% pay increase this year. Anybody get one of those? Any hands want to go up about how much of a raise you got on this invisible tax called inflation? And now the uninvisible part to fight this thing that's been imposed on you is increased mortgage rates. Man, I am very worried for anybody who's been a big fan of the adjustable rate mortgage over the last 6 months to a year. So I sure hope that there's a very small number of folks who did that. But the number is growing, and as it grows as we head to the end of the year, because The financial, and I'd love to hear from a financial person. I know I have several lenders out there who listen to the show. What's now the ratio you're seeing between fixed and adjustable rate mortgages? I would love to hear about that, particularly in local markets and if there's variance from market to market. I know it's huge now in Silicon Valley. So I'd love to know what that is, because that's priming the pump. That is priming the pump for a huge we are underwater moment, and our interest rates are about to bloat and screw us over so that we can't make our mortgage payment every month. And when you're talking about a purchase price of $1.5 million, $1 million to $1.5 million, depending on where you're buying around here, that's a big amount of money. So I hope we've given you some good info. I think we've talked about some, and always stay calm, right? This is not the time to start to freak out. Let's let the numbers inform your decisions. So keep that in mind as we move forward. Of course, I'll be keeping an eye on this. As always, the goal is to give you more information than you invest in time. And I hope I've achieved that today. I hope my emotional enthusiasm for the topic helped to feed how interesting it was covered. I'm not going to make any claims one way or the other on that one. But I do thank you for spending your valuable time with me. Thanks again for listening. I will talk to you all next time.